Welcome to ETF Edge, your go-to place for all things exchange-traded funds. I'm your host, Contessa Brewer, sitting in today for Dominic Chu. Most investors, of course, are laser-focused on that next Fed meeting in December. Our next two guests advise, be wary of seeing the forest for the trees. Joining me now is Davi, CIO at Astoria Portfolio Advisors, and Sofia, Massie, the CEO of LionShares. Good to see both of you today. John, let's kick it off with you. I have this song stuck in my head based on your view. It's the, wait. You can go your own way. You're kind of like just off on your own saying, hey, we're not in a end of cycle bubble. We're in a completely new cycle. Tell me why.
Well, the Fed cut rates 4 times last year. They cut rates twice already. They're going to go again, whether it's December or January. Historically, whenever the Fed cuts interest rates, usually that's a turn of a new cycle. Market leadership does tend to change quietly. If you look under the hood, Contessa, emerging markets are up 27% year to date. Developed international markets are up 27%. If you look at real assets, whether it's gold, up 54%. I mean, if you just look at sectors like banks, which benefit from higher rates, steeper curve, KBWB is up 19%. You look at industrials, XLI, up 16%. They've all beaten the S&P 500, which is up 12%. So between tax cuts, rate cuts, tariff cuts, liquidity is coming back into the system. So I think, stocks have a green light. I just would evolve the portfolio away from just large cap tech. All those sectors and asset classes I mentioned are cheaper than a market, and I think they can be a good offset to what's an expensive large cap tech position, which dominates most portfolios.
It's not every day you get singing on ETF Edge. I would have a song for you, Sofia, but the truth is, I just want to hear what you think of as the bottom line here for the end of 2025 heading into 2026.
Yeah, I mean, we've really had a record year for ETFs, and I don't see any sign of that slowing down really across all metrics. Record AUM, record numbers of new fund launches, new issuers. We've seen over 900 new ETFs launched this year.
Is it a death knell for mutual funds?
So that's really the question. And I do believe that the time of the mutual fund is coming to an end. When you look at the record inflows that have been seen by ETFs, that's 1.2 trillion this year so far. That's paired with a $1 trillion outflow from mutual funds. So it does seem like a lot of that growth is coming from outflows of mutual funds.
Part of it, too, is that you have people looking for bigger returns in their ETFs, and now they're looking at levered ETFs. Is that smart, do you think, or is there a warning sign there?
I do think there's definitely caution to be had with levered funds. The democratization of these new trading strategies is fantastic, but that does come with caution that these investors need to have. These are very sophisticated trading products, and levered ETFs, they provide exposure to the daily returns of their benchmark, not year over year. So we've actually seen a lot of these levered single stock ETFs underperform their benchmark this year. Investors really need to understand what they're buying into. Additionally, the way that these ETFs get their exposure is via swaps. And the interest rates that people are paying in order to access this leverage, it can actually be fairly high. So when you look at the swap rates, you're basically taking out a high interest loan, roughly 10%, in order to get this leverage exposure. So investors need to understand whether that's a trade that they really want to take on.
Tail end of last week, John, we saw the markets really moving on Fed news. Now, you're reminding people that inflation is eating your bond returns. People who are cautious, who probably would not consider levered ETF, may have been really relying on bonds here.
Yeah, I mean, I think, there's a lot of demographic structural reasons why bond ETFs continue to see a lot of inflows. People are looking for, conservative income, not a lot of risk. But, if the ag index is up 7% year to date, half it has been lost to CPI, which is 3%. And then, real world inflation, you go out in the real world and grocery shopping, car stuff. I mean, it's well north of 7%. So we've been arguing for the last 4 years that you need to protect your portfolio and own asset classes and sectors that benefit from higher inflation. So things like, gold is up, 54% year to date. Bitcoin, if you looked at a chart of like Bitcoin, gold, S&P, NASDAQ, I mean, the last 4 years since we've been living in this structurally higher inflation world, both gold and Bitcoin have dramatically outperformed SPYs and Qs. And that's after some, pretty monster back-to-back years, the last 2 years for SPYs and Qs. So it's not about your nominal returns, it's about your real returns. And then certainly on an after-tax risk-adjusted basis. So, we try and help shield portfolios from higher inflation.
The other thing that we saw at the end of last week is, NVIDIA earnings came out, really stellar report, got a little bit of a stock pop, and then just fell. This Meg Seven story has been so long, so hard, that just putting the pedal to the metal. John, are you now looking past Meg Seven?
We are. I mean, I think if you're benchmark oriented like our firm is at Astoria, you have to have exposure, to these, large cap tech and growth stocks. But, incrementally on the margin, you should be tilting away because, as we argue at our firm, we're living in a structurally higher inflation world. The Fed is cutting rates. Like, why do you want to take so much risk in just 7 stocks or, one stock, NVIDIA makes up, 7-8% of the S&P when you have a whole world of opportunity out there? And as I mentioned before, emerging markets are up 27%, developed international markets up 27%. These are beneficiaries of a weaker dollar, the debasement trade, which is very well publicized out there. Contessa, if you take the Mag 7 out of the S&P the last 3 years, Europe has actually outperformed the S&P. So it's just time to evolve your portfolio. It's prudent as a risk manager, diversified portfolio manager to just nibble and own asset classes and sectors that benefit from higher inflation. And as I keep saying, the Fed is cutting rates.
Well, so John, when you're looking at emerging markets and the rest of the world, how do you factor in what is unknowable? We have seen so much geopolitical volatility. How do you know that putting your money in these other sectors? I mean, tariffs have played havoc with global trade.
Yeah, so I do think the catalyst was the weaker dollar, and it corresponded to when Trump was elected, and then you started seeing the rise in protectionism. You saw Germany doing big fiscal stimulus. So investing is always about having a catalyst, and even though people have made a claim to rotate into developed or emerging markets, the catalyst was actually Trump being elected, Germany doing fiscal stimulus. And then all of a sudden, the dollar has weakened. If you look at euro dollar, it started the year at 103, 104, got down to 119. For me, as long as I've been investing, anytime the dollar weakens, gold goes up, non-U.S. outperforms U.S. And that's really the playbook we think you should be following for this year and for next year.
Sofia, what do you think when you're looking at the market and these other trends that we're talking about? Where do you think there are opportunities?
I've always been a believer in classic capital asset pricing model. I do believe diversification is the solution for long-term investors. If you're someone who's saving for retirement, you need to remember that you're investing for a 20, 30-year time horizon. And when that's your objective, that's very different.
If you're 20 or 30 years away from retirement, and not all of us are.
Exactly. So it really depends on the investor, and you've got to remember that suitability when you're choosing your investments.
Right.
I like to think about the new generation.
I mean, I think there's a difference in perspective that's really valuable here. But one thing is that they now offer ways to invest where you're like, okay, well, here's how old you are. You expect to retire in 2035. Just park it in this fund and be happy with that. Is that, do you think, a way to miss out on growth, John?
Target date funds are okay. That's an option. But, we would argue that you can kind of reverse engineer yourself at a cheaper rate. Some of those target date funds, they charge, pretty expensive fees. You can build a globally diversified portfolio across, U.S., non-U.S., across different sectors, regions, asset classes for, as low as like 10 basis points. So, to your point, if you do have this very long time horizon, you should be tilting away from Mag 7 or certainly, let's say in my case, let's say I don't have 30 years. Even more of a reason, why would you not tilt away? Because, starting valuations are very, very important, right? Your entry price is very important. And these stocks are not cheap, right? They've been in favor for the last, 5-10 years. And you like I said, the world is an opportunity. And now you actually have a catalyst for owning non-U.S. or sectors like industrials, energy, materials, gold, cryptocurrencies. That's where our portfolios are tilted.
That's a really interesting point, because if you look at all of the talk about whether AI is a bubble and the ETFs that are trying to capture the growth and the interest and the opportunity in AI, when you're looking at someone who might be invested, Sofia, 20 years out or 30 years out, does it matter whether we're in an AI bubble right now? And are there other, I'm thinking about the fact that we've had our first hack orchestrated by AI, or the fact that climate risk continues to be a top concern for leaders around the world. Are there ways to invest in sectors and industries that you can wait for 20 years to see those returns?
Yeah, I think analysts have an idea of how much value AI will add to our economy. I don't think we really understand how that's going to play out between different companies yet. Mm-hmm. So I have this sense that right now we're pricing in this probability that one company may be the one that dominates AI and ends up being a big player in the future. If you look back at the .com bubble, how many hundreds of internet companies were out there? How are we supposed to know that Amazon was going to be one of the big winners out of that? And I think we'll see something similar now, where as various companies are beginning to adopt AI, we'll eventually see some of them end up being the big winners, but we're not there yet in terms of knowing who that's going to be. And it's really a question of, are incumbents in various industries that are currently untouched by AI, will they be able to innovate their internal systems to take advantage of AI in a way that's not just using ChatGPT in your internal systems, sure, but rethinking from the foundation level how to incorporate AI models in the way they provide services?
John, if you're looking at the ETF industry right now, 2025 has been a year of record flows, of innovation. If you could just choose almost any metric, what could be next for the industry in 2026?
I think there's a ton of crypto filings out there. I think they'll make their way into the ETF ecosystem. I think there's a high probability that a lot of cryptos are launched and then they may actually wind up closing for lack of demand, or the crypto cycle closes. But I'd expect whatever the flavor of the month or the quarter is, to continue to be launched. It's very easy to see, hundreds of more levered stock ETFs launched, and then the -1 or the -2s. So, unfortunately, the industry is getting, more and more complicated. You need to do more and more due diligence, but, we're going to have a lot more ETF launches for sure next year.
And Sofia, I know you're looking at rules around share class as a catalyst for the industry.
Yeah, like I mentioned earlier, we've seen mutual fund outflows as a big driver of growth in ETFs. And I think now with the new share class updates where we can have ETFs as share classes of mutual funds, that's just going to act as another catalyst that's going to drive those flows from mutual funds into ETFs, especially as these big powerhouses in the mutual fund space shift their distribution to focus more on growing the ETF side of their business.
Sofia, thank you so much for your time today. Appreciate it. John, thank you for joining us. Remember, you can catch all of our other content at etfedge.cnbc.com. Thank you for watching.
Get the ABCs of ETFs with the ETF Edge newsletter. Your weekly update on the hottest trends, expert analysis, actionable ideas, and exclusive insight from top industry experts. Sign up now at cnbc.com/ETF Edge newsletter.